Everyone, let's go into a deep dive of the U.S. stock market after one of the worst weeks the market has seen, but why I don't think it's time to panic, and let's drill down why. Plus, I have a question for you, so make sure you leave a comment, like, and subscribe, because I want to know your feedback. So let's first start with the banks. And the reason why I want to drill down on the banks instead of the S&P, for example, is because retail traders don't mess with the banks, right? Retail traders, your mom and pop, your Wall Street bets, your Robinhood folks, they're not messing with Bank of America, JP Morgan, Deutsche Bank, Goldman Sachs, right? They're not trading those stocks. So institutions are the one usually trading the banks. So if we pull up the XLF, the financials ETF, you can see that after a rally, we came back down and look where we started to bounce off. All of this support right here. So this is healthy. Remember, 80% of gaps get filled. Drill that into your head. So we had a gap, and let's just look at it. We had a gap here. We filled it. We had a gap here. Well, really a gap here, but let's just call it. And what did we do? We filled it. So the risk versus reward trade setup, and if you're looking at TradingView, they have a cool little thing where you can do it. The risk versus reward trade setup is if you get long up in here, like I did on Friday with Bank of America and JP Morgan, all you do is just go and put your stop under the low. So like 47.22 around, right? So if we take out these lows, you break 1, 2, 3 legs of support, you're out the trade. But really good, solid risk versus reward setup, and you don't have to worry too much about, oh, you bought some AI stock and it's down 50% the next day. So now if we know the banks are moving, let's drill down into some individual banks. Let's first start, though, with Deutsche Bank. And look at this chart. Look how bullish Deutsche Bank is. And we've been seeing lots of call buying on the news flow scanner in the stock over the past couple months. I don't know about you, but a bear market at Deutsche Bank right near a 52-week high doesn't really scream bear market. If we look at Barclays, right near 52-week high, right? You can see it's already filling that gap, right? That downturn that we had already filled it right here. So very, very positive, right? If we go to some of the U.S. banks, Goldman Sachs, starting to bounce, and look where it's at. Gap fill. What do we do? Fill the gap. All right, positive, right? Good risk versus reward. Let's look at Wells Fargo, kind of the crappy bank. Same thing. Gap filled. Support, support, support. Broke support, flushed out sell stops, starting to bounce. Actually leading the way, you can argue, in the U.S. banks. City junk. Gap fill, back at support, starting to hold. Bank of America, brought past support, but if you look at volume point of control, it's a free study you can look up at TOS. Back into value, starting to bounce. JP Morgan, back at support, starting to bounce. So you get what I'm saying, that the banks, the U.S. banks, if they start leading the way, especially following European banks, very bullish for equities. So therefore, what mostly makes up the banks? IWM. IWM, one of the, besides the NASDAQ, led the way higher on Friday. This is one name I have been buying, small and mid caps. And if we look at IWM, we had some of the nastiest, we'll call this a massive H sell pattern, right? Lowercase h. What do? We're starting to pull back. Support, support. You could call 191 and change support. But, 1, 2, 3 tests. Again, good risk versus reward. Trying to find that bullish momentum here as everyone is kind of freaking out, right? What you don't want to do is chase when it's safe and back up here. Everyone's going to be buying. You really want to start to acquire, when no one else wants to. So we're trying to be proactive rather than reactive, right? Now, if we do look at the big semis, they're starting to move. Let's look at the SMH, right? Kind of a V bottom. So this is super bullish, right? in the SMH, one of the, and look, support, support. Here was the breakout right down in here. Look where we're at, right down in here. So we get in there, right? We're starting to bounce. We look at NVIDIA, right? The big mover of the market. Right, you already know. Master indicator, long triggered. Look at this bad boy go, right? Very V, bottoming, bouncing. So I know everyone's saying don't buy the market and the bears and tariffs and all that other stuff, Ukraine, war, blah, blah, blah. But all I wanted to do was just really try to calm your mind and not say, hey, it's a doomsday out there. Maybe the market moves lower. I would like if it moves higher. I think the probability and math are starting to move higher. I would say the only thing I'm a little concerned about from Friday's rally is the trend, right? We kind of had an extreme low reading here at 0.5. Anything below 0.6 is extreme. Therefore, the trend should bounce and equities could sell off, but maybe we open in the trend on Monday around 1.2, and then we fade, and then equities rally. That could happen, and that's good. So a lot of good. One question I do have for you, though, is two things, actually. One, are you still scared of the current market? Are you fearful? Are you starting to buy? And then two, I've floated with the idea of coaching. I used to do this way, way, way back in the day. And again, just an idea, and I have to talk more with my executive assistant with it next week. But I just want to see, it will be very pricey, just a heads up, if I do. I just want to see if there would be demand for it. It would be in-person meetup, flying to your home or office or in a big city like Vegas, Miami, New York, Orlando, basically somewhere that's fun to meet. Spend a day going over everything in the markets, and then maybe like some kind of coaching call maybe once a week or so. Just floating the idea around. It will be very, very, very expensive, though. Obviously, to get me out the big ranch would be pricey, and it would be, not just a one-time thing. Probably, a full year commitment. I'm thinking with about one meetup to kick you off, just so I could be hands-on, and then weekly calls to make sure we go over everything. It would be very, very individual. It would be independent because I'm an independent contractor, so not with any of the companies. Just a heads up there. Again, just floating the idea around. I do have an executive assistant, and I pay, quite a lot of money for her, so I might as well get my money's worth and try to book some traveling to y'all and try to get that hands-on approach. So let me know in the comments if that's something you might be interested in. Again, it may not happen. It may happen. Just floating with the idea around, because I just see so many people panic and so much bad advice going out there. People trying to focus on economic data, trying to day trade, S&P or SPY, weekly 0 DTs, and like that is very, very difficult. And trying to, call the tariff news and predict this is very difficult. So all I want to do is really give you a professional trader's approach. I've crushed it and I've lost a crap load of money as well. Learn from my mistakes so you don't have the ups and downs and the wild P&L swings. Like, for example, this week I spoke to one gentleman who made $60,000 on Intel calls and said, Lance, I closed him out too early at the open, but thanks to the penny option scanner, I would have never bought him without it, and I made 10x my money. And then I spoke with other individuals who lost hundreds of thousands of dollars on margin trying to dip by the market and just got crushed. So I hear it all. I've experienced it all. So I'm just hoping some hands-on approach will be beneficial. So let me know in the comments, and I'm out.